Robert, this week we received the first estimates for second quarter GDP, and you had warned us that this number would be significant. How did it turn out?
Yes, Susan, indeed it was a historic decline in second quarter GDP, falling at a 33% annualized rate. A couple things are very important to unpack from that number. That was 33% as if it were going to continue to fall at the same rate for another 3 quarters. I know that's complex, but what it means is it fell about 8% quarter to quarter. If we simply measure where it was in the first quarter and where it was in the second quarter, 8% decline quarter to quarter, 33% as if it were going to go a whole year. The other important thing to know about GDP is that this 33% annualized rate of decline represents a significant pullback in demand. A lot of that coming from consumer spending, some of that coming from business investment and other sources. What it does not mean is does not mean a 33% contraction in productive capacity for the US. We didn't close 33% of our factories and research facilities and things like that. So I am expecting demand to come back. However, if demand stays weak, eventually that will result in a pullback in productive capacity.
Robert, with all this information coming in, how is it affecting consumer confidence?
Well, Susan, we did see a hit to consumer confidence in July, and that is coincident with the increased social unrest that we've all been witnessing lately. I think there is a concern now that we have Congress working on a fiscal bill. We knew that deadline was coming up for the enhanced unemployment insurance benefits. We're hitting that deadline today. So there is a concern that these multiple millions, tens of millions of individuals who are on unemployment right now, unemployment insurance, are going to be seeing a pretty significant pullback in what they're able to collect. Now, I do expect Congress to continue to try to forge ahead here. We could even get some retroactive mechanism to address this, but right now we are staring at a cliff effect in terms of the reduction of unemployment benefits. I don't expect us to maintain the $600 going forward in added benefits. That could be brought down to $200 or $300, but I think Congress really does need to consider how to smooth this cliff effect out so we don't have a big jolt to the U.S. economy.
And Robert, what can you tell us about the Fed meeting this week?
Yes, we did have a Federal Reserve meeting over Tuesday and Wednesday, and the Fed in many ways did what was widely expected by leaving interest rates unchanged, near zero. They didn't quite come up to expectations in terms of the language. I did expect to hear more about forward guidance, the Fed telling us what they're going to do in the future with interest rates. I did expect to hear more about linking quantitative easing or asset purchases to yield curve control. We didn't hear much about that. So in a sense, the Fed is in a watchful waiting mode. I think perhaps they're waiting to see what comes out of the fiscal package. They're waiting to see how their year-end, their policy review all comes together. But I do expect to see some more language from the Fed in a not too distant future, maybe September, talking about modifying forward guidance, saying we're going to keep interest rates low until, and maybe that until might be until we see inflation come up, and we're going to buy bonds, we're going to have asset purchases to such an extent that we start to exert control over specific Treasury bond yields, yield curve control. So these are two things I think the Fed is going to roll out this fall.